Welcome to the lecture 1 for ACCA paper AA for December 2019 exams. I am Kashif Kamran, your tutor. Today we are focusing on the syllabus area A, which is audit framework and regulations. Inside the syllabus area A, which is audit framework and regulation, there are 4 sub areas. Number 1, assurance. Number 2, external audit. Number 3, corporate governance. And number 4, code of conduct. So this is the syllabus area A of the AA syllabus mentioned by ACCA. Let's first start today with the area known as assurance. And let's explore the knowledge a student of a AA exam should have about assurance. Now, assurance is a moderate syllabus area. You can expect a multiple choice question on assurance, so you should have knowledge of this area. And more importantly, examiner can ask you to mention or explain something about assurance in exam paper, or might even ask you to explain the elements of assurance in the exam context, which has been the case in the past papers. So it's not an area which you should take lightly, but it's an area which has a moderate exam focus, and it's totally knowledge oriented. Let's start on with the first topic, which is assurance. Now, all of you know that the title of your paper is Audit and Assurance. So in this first lecture, I will be connecting the concept of audit with assurance. That what is the connectivity between audit and assurance, because that's the title of the paper you are dealing with. So let's start on with the journey. Assurance. Now, when I look into assurance from the perspective of the AA exams, as a student, you should know that there are 2 types of assurance, which I will be covering in the lecture. Secondly, you should know what are elements of an assurance engagement. So these are 2 expectations of the AA examiner from a student of AA, that you should know the types of assurance and you should know the elements of assurance. So what is the learning outcome from this lecture? There are 2 learning outcomes from this lecture. Number 1, the types of assurance, and number 2, the elements of assurance. Let's start on with the first one. Now, to understand assurance, we should first understand the external audit, because our syllabus is focused on one type of audit, which is known as external audit. And as a student, you should know the external audit process, and you should know the mechanism through which the external audit is conducted, and what is the benefit of an external audit to the shareholders of the company. Let's start on with it. There is a company, and the company is owned by the shareholder, right? And we are speaking of a listed company because external audit is a mandatory exercise for a listed company. So there is a company, an XYZ company, which is owned by the shareholders. The shareholders appoint the directors, and the director manages the company. Now we know there is a relationship, there is a steward relationship, or there is a principal agent relationship between a shareholder and a director. The shareholder being the principal of a company, being the owner of the company, they appoint the directors, and the director manages the company. So that is one set of relationship. Now, when you look at this relationship where the shareholder is the owner and the director is the manager, they're running the company. Now, there is a split of duties. Shareholder, they own the company and they want return on their investment in the company, and the director needs to manage the company very successfully, very effectively, so that they can generate good returns for their owners or shareholder. Now, in this process, how and when will the external auditor comes in? The director prepares the financial statements. Now we know the financial statement is a very important output, and this is an output which for the shareholder is very important, because the shareholder, on the basis of the financial statement, they measure the performance of their company. From the financial statement, they get to know their sales, they get to know their profits, they get to know the earning per share. They also get to know what has been the gross profit margin of my company, or what has been the return on capital employed, the investments I have done in the company. So the financial statement is a very important document. Now the directors are preparing the financial statements, who manages the company, and the shareholder is measuring the performance of their company or their investment on the basis of the financial statement. And we know as accountants that financial statement is a very important output and is a very important document. Now, there is a problem that when the director is preparing the financial statement, there can be an element of window dressing, or there can be an element of a fraud in the financial statement, because directors do have their self-interest. The directors are working in the company, or they are managing the company for the sake of their remuneration, for the sake of their bonuses, for the sake of the perks and the benefits they get as a director of a company. And that is the self-interest, right? At the end of the day, the director wants to make the company successful, but he's also concerned about his self-interest. He's very much concerned about his remunerations and bonuses and perks and facilities which he gets from the company. And that is the point where the director can get greedy. And that is the point where the self-interest of the director takes over the interest of the shareholders. The shareholder wants a true and fair picture of the company, but the self-interest of the director can dominate the true and fair picture of the company. And that is the point where the director can indulge in fraudulent activities, or the director can window dress the financial statement to show a better picture. And when he shows the better picture, the shareholder will be happy. And when the shareholders are happy, they will reward the directors. They will reward the directors with increments in their salary, with the increments in their bonuses, with the increment in their lifestyles like perks. So the directors will be happy. So this is the problem here, that the self-interest of the director can be very risky here, and the self-interest of the director can help in the manipulation of the financial statements. And when the financial statements are manipulated, the shareholders is getting a wrong picture of the company. And when the shareholders is getting a wrong picture of a company, they can take a wrong decision, and they can even reward the directors when they should not have rewarded them. So now in this process, there needs to be a check and balance. There needs to be someone who checks the director. There should be someone who should evaluate the directors, whether they have done a fraudulent activity or they have not done a fraudulent activity. So who should that be? The shareholder thought that we should appoint an auditor. Now, this is an external auditor, and we know anyone who is external is more independent. So we also say independent auditor, or we say external auditor. So the shareholder thinks that if I want to check the directors for the wrongdoing, or if we want to check that the directors are not doing any fraudulent activity, we should appoint an auditor. And this auditor, because he's independent, because he's outside the company, because he is external, will do what? This auditor will add credibility to the financial statement. That is the most important thing, because when the directors are preparing the financial statement, they have a self-interest, and that self-interest can dominate the financial statement. So the directors' wrongdoings needs a check and balance. So the shareholder thought, let's appoint an auditor, and the auditor would then add credibility to the financial statement. Now, that is the most important thing. Now, when the auditor adds credibility, we know auditor adds credibility how? Auditor checks the financial statements. That is known as the audit, right? Auditor checks the financial statement. And then the auditor, by checking the financial statement, gives an opinion on the financial statement. And when the auditor gives an opinion on the financial statement, that opinion is adding the credibility, because the auditor says in their opinion that whether the financial statement gives a true and fair view, or whether the financial statements do not give a true and fair view. Because when you check the financial statement, we can have two outcomes, right? So the auditor needs to express an opinion whether the financial statements give a true and fair view. And it could be the vice versa, right? That it do not give a true and fair view. So the credibility is very important, because this credibility is enhancing the confidence of the shareholder. See, who appointed them? The shareholders appointed them, right? So this credibility will eventually help whom? This credibility will help the shareholders, right? And the shareholder will be more confident. So what exactly is the credibility doing? The credibility is enhancing the confidence of the shareholder. The credibility is enhancing uh, the shareholder trust in the financial statement, and the shareholder would think that the financial statements are more reliable when the auditor have checked them. So this is a mechanism in front of you. This is a process in front of you where the shareholder owns the company, the director manages them. But when the director prepares the financial statement, the directors do have their self-interest. And if the self-interest dominates, then the financial statement might be misleading, might have window dressing. And that's where the need of the external audit comes in. We know external audit is a regulatory exercise. Every listed company is subject to external audit. So if a company is listed, automatically you are under the external audit, because you need to give credibility to the shareholder. And that is the only thing which can prompt investment in a stock market. So if there is no credibility, no one will invest, right? If there is credibility, the people will come to the stock market and they will invest in the companies, and that's it. That's how the stock market runs. If there is no credibility in the stock market, no one will come and buy the shares of the company. So this is a connecting process, right? So try to understand, as a student of AA, the value of external audit. Do you all realize that external audit is a valuable exercise? Because not only external audit is boosting the confidence of the shareholder, but also try to understand that the external audit is very, very important for the prosperity of the stock market. The stock market runs on trust. The stock market runs on true and fair. The stock market runs on confidence of the shareholders. If the shareholders are not confident, the stock market will collapse. So try to understand the broader picture here, that the mechanism of the stock markets, the New York Stock Exchange, the Tokyo Stock Exchange, the Pakistan Stock Exchange, how these stock exchanges are run. They run on the basis of trust and confidence of the shareholder. And that is what comes from the external audit. So external audit indeed is a valuable exercise. And you should all recognize that when you're preparing for your double exams. Okay, the next thing then, purpose of external audit. Now, I have already mentioned that the purpose is to add credibility. The purpose is to enhance the confidence of the shareholder. The purpose is to express an opinion on the financial statement. But let's consolidate the purpose of an external audit. The purpose of an audit is to enhance the degree of confidence. Now, that was exactly something we were learning on the preceding slide. Enhance the degree of confidence of the intended users in the financial statement. So the confidence of the shareholders, the intended users, will enhance in the financial statement. So that's one purpose, right? So what's the purpose? The purpose is to enhance the degree of confidence. And how you enhance the degree of confidence, we've already studied that in the preceding slide. This is achieved. How you enhance the degree of confidence? This is achieved by the expression of an opinion. The auditor express an opinion that whether the financial statement gives a true and fair view or not. So this is achieved by the expression of an opinion by the auditor on whether the financial statements are prepared in a material respect in accordance with applicable financial reporting framework. Adherence. If the financial statements are prepared in accordance with the applicable financial reporting frameworks, which is the accounting standards, then that means the financial statements are true and fair. But if you have breached an accounting standard, or if you have deliberately breached an accounting standard, or if you have deliberately omitted an accounting standard, then that is a window dressing. That is a fraudulent financial reporting. So the auditor is expressing an opinion, right? That whether the financial statements in all material respect, that is very, very important. In all material respect, this is very important. Material, when the auditor goes for the audit, there is a time limitation. You need to understand that. Uh, Logically, a listed company uh, as big as Nestle, Pepsi, Apple, Amazon, IBM, Google, General Motors, Toyota Corporation, and the list goes on. Try to imagine these giant organizations. They're all listed companies, right? And the audit of these listed companies are completed in maximum 2 months, even less than that. Now imagine the size of these companies. They are they have global presence. They have so many subsidiaries. They operate throughout the world. Is it possible for the auditor, when he goes for the audit, that the auditor checks every single transaction in the ledger, every single transaction in the journal ledger? No. The auditor needs to give an opinion not on every transaction. Auditor needs to give an opinion on only material things. Material means important things, significant things. So auditor will not be looking at petty things, minor things. Auditor will be looking at significant things. Yes, the auditor needs to determine a threshold of material. That is very judgmental. And you will be learning that in the later course of the AA. But material is something which is significant, and that is something judgmental. Something which I believe is significant might be insignificant for another, because material depends upon the thought process, that how I define what is significant or what is material. But the end story is, when the auditor goes for the auditor is only looking after material items in the financial statement or material items in the journal ledger. The auditor is not looking for insignificant things in the journal ledger of the company, because you are having a time restriction. And within the time restriction, you need to produce the best opinion. You need to produce the opinion that the financial statements in all material respect. So you are telling that to the shareholder, that I've only looked at the financial statement in all material respect. Yes, there might be a fraud in immaterial things. There might be something wrong in the immaterial things, but I'm not responsible for that. I'm only responsible, or I'm only liable as an auditor for material respect. So that is a very, very important condition of audit. You should note that down very carefully, that audit has a time limitation. If the examiner asks you what are challenges, what are limitations of the audit, the first limitation of the audit is that audit has a time limitation. Now, when the auditor has a time limitation, that is a big problem. Now, just try to understand, when you are conducting an external audit, we should also realize that external audit has certain limitations. And the limitation starts from time. There is a time constraint, as mentioned. Now, when there is a time constraint, it's humanly impossible that you look after everything. So when the auditor goes for the audit, considering there is a time restriction, and you look at the financial statements in the time constraint, so you need to look at the financial statements for more important things. So auditor needs to decide what are more important things in the financial statement, what are material things in the financial statement. So auditor looks at more important aspects of the financial statement. Auditor is looking at material things in the financial statement when he's going for the audit. And because the auditor cannot look at all the things because of the time constraint, auditor do sampling. You take a sample. Sample means choosing. If there are 10 items, I will not take 10 out of 10. I'll say, okay, let's choose some 5 of them, 6 of them. So I need to take a sample size because I cannot verify 100% of items in the financial statement. So I need to take a sample size, and sample size means less than 100%, right? Sample cannot be 100. The sample cannot be the whole population, right? The sample has to be less than 100% of the population. Less than 100% of the population. Now that means something very important. When we go for the audit, we have a time constraint, right? We have a time constraint. Because of the time constraint, we look at the more important aspect of the financial statement, which is material. And to do so, we verify less than 100% of the population because we cannot verify 100% population. Imagine a company like Amazon or any e-commerce giant having millions of sales transaction. Will you be verifying every single transaction of sales of Amazon? It's humanly impossible. But yes, you need to verify the bigger transactions, the significant transactions by taking a sample size. But that all means because of the constraint, because of material things, not immaterial things, because of less than 100%, the auditor is expressing an opinion. Auditor is not giving a certificate, because when you give a certificate means a guarantee. Auditor is not giving a guarantee. Auditor is giving a opinion. An opinion is an assurance. Opinion is an assurance, which is a degree of confidence, which you read on the preceding slide. It is a degree of confidence. It's not 100% because you have not verified 100%. It cannot be 100% because you didn't look for immaterial things. So try to understand, it cannot be a certificate, right? So is the auditor giving a certificate? No. Is the auditor giving an opinion? Yes. An opinion is not 100% because opinion is a view, is a viewpoint of a certain person. If I give an opinion, that's my viewpoint on the basis of something. So that sets the viewpoint, right? And the viewpoint is not a guarantee. The viewpoint is just an assurance. So that means assurance is something less than 100%. Because assurance, can an assurance be a certificate? No. So that means when we assure someone or when we certify someone, to certify someone is 100%, right? To assure someone is an opinion. An opinion is a viewpoint. So the viewpoint can be right, can be wrong. So there is a degree of risk. So assurance cannot be 100%. So assurance is less than 100% because we didn't verify 100% things. So assurance is less. I hope you pick this sign here. Assurance is less than 100%. So try to note these things down carefully because these are basics, right? And which you should have as fundamentals into the very first lecture. Okay, then from the purpose of external audit, where we have already learned the limitations and we have already got to know the meaning of the word opinion. Opinion is an assurance and assurance is less than 100%. Let's move one step forward. Reasonable assurance. Now we need to discuss that there are two types of assurance. One of the assurance is known as reasonable assurance, and the other one will come later. A reasonable assurance is a high level of assurance, but not an absolute level of assurance. So that means a reasonable assurance is a high level of assurance. What was the meaning? It is a degree of confidence. It is a degree of confidence. It's a high level of assurance. It's a degree of confidence. Degree of confidence. So we enhance the confidence of the shareholder, right? So are we enhancing the confidence to 100%? No, because it's a high level of assurance, but not an absolute level. Is it 100%? No, cross. It is a high level of assurance. That means it's less than 100%. So can assurance be measured? No. Can we put assurance in a quantifiable form? No. But what is the reasonable assurance? It's a high level of assurance. Now, can we measure high level? No, because assurance cannot be measured. But is it a certificate? Is it a guarantee? No. So is the auditor giving a guarantee? Absolutely no. Is the auditor giving a certificate? Absolutely no. Is the auditor giving an assurance? Yes. Which assurance? High level of assurance. So if the examiner asks you, define the term reasonable assurance. So you will say a reasonable assurance is a high level of assurance, but not an absolute assurance. So it's a degree of confidence, but we cannot measure the degree, right? We cannot measure the degree. This degree cannot be measured, but it's high. So are we very clear on this? Understanding the terms. Do we know a high level of assurance, everyone? And do we know what is an absolute assurance? And did we discuss the limitations on the preceding slide? That why cannot it be absolute? It cannot be absolute because we have a time limitation. It cannot be absolute because we are only looking at material things. It cannot be absolute because you are verifying less than 100% of the transactions. That was all discussed on the preceding slide. So everyone should know, why cannot the auditor give a guarantee? Auditor cannot give a guarantee because there are limitations. So what max can an auditor give? A reasonable assurance, which is a high level of assurance. And that is the confidence which goes to the shareholder, and that is the confidence which goes into the stock markets, and that's how the stock markets are run throughout the world. So audit is a reasonable assurance engagement, right? So reasonable assurance engagement is basically audit. So when we do the audit of the financial statement, the audit of the financial statement is known as a reasonable assurance engagement. Now you should all know why we should have an audit, what is the purpose of audit, and what is a reasonable assurance. Next, review moderate assurance engagement. Now we just learned reasonable assurance. Now we come across another term known as moderate assurance. Now these are two types of assurance. If the examiner asks you, explain the two types of assurance, you will say one is reasonable and you know the definition. One is moderate, you are learning them now. Or if the examiner says, differentiate between a reasonable assurance and a moderate assurance, let's see how you will go about that. Moderate assurance. Can you see this word here, review? First of all, you need to understand that an audit firm like the big four audit firms, I hope you're familiar with the big four, like the PricewaterhouseCoopers, Ernst& Young, Deloitte, KPMG, the audit firms, right? I hope all of you are familiar with audit firms, right? Now, audit firms offers services. Audit firm is not just offering audit, right? Audit firms offers many services. You will be exploring these many services if you opt for the advanced audit and assurance paper. But we're not just interested as a double A student to know the types of services, but yes, the audit firm do offer many services because audit firm is a service provider. Now, when the audit firm is offering services, one of the service which is part of your syllabus is known as audit of financial statements. And we know that when the auditor offers the audit of financial statement, the auditor expresses a reasonable assurance. Now, there is another service which the audit firms offer, and we know that this is for the listed companies, right? The audit of the financial statement is for the listed. But there is another service which the auditor offers, which is part of your syllabus, known as review of financial statements. And this is for small companies which are exempt from audit. Review. You need to understand one thing. Financial statements, audit of financial statement, and review of financial statement. So there has to be a difference, right, between audit and between review. Eventually, the subject matter is the same. The subject matter of audit is the financial statements. We audit the financial statement. The subject matter of review is also the financial statement. But in one case, it's a listed company because this is mandatory, right? This is mandatory. And we've just understood that audit results in a reasonable assurance. And you will be exploring that in the later syllabus. But there is another service which is for small companies who are not listed, or the companies which are exempt from audit, on whom audit is not mandatory. They can have a review of the financial statement. So first of all, review is optional. It's not mandatory. It's upon the small company, right, whether they want to have a review of the financial statement. It's not mandatory like an audit. So the small company has to take a decision whether they should have a review. If they do have a review, the review will result in a moderate assurance. And that's the second level of assurance. So the first thing you should know that there are two services, audit and review. Audit is for listed companies, it's mandatory. Review is for small companies which are exempt from audit, and review is optional. If a small company likes to have a review, they can have it. But what end assurance they will get? They will not get reasonable assurance, they will only get moderate assurance. So that's the structure differentiation from your examination point of view, which is existing between a moderate assurance and a reasonable assurance. Now you all know that a reasonable assurance is a high level of assurance, but not absolute. So let's see, then what is a moderate assurance? Is it less than reasonable assurance? Technically, that is the best definition, right? Because we are scaling down. We cannot be absolute, right? We have to be reasonable. Now, after reasonable, there is another level, which is moderate. And see, the moderate assurance is going to a small company. So obviously, the level of assurance will scale down. But let's see how much. Let's start the understanding of a moderate assurance engagement. Review of the financial statement is another service, I just mentioned that, offered by the auditor under the ambit of the International Standards on Review Engagement. So there is an International Standards on Auditing, ISA, under which comes the audit of the financial statement, and audit of the financial statement is a reasonable assurance engagement. But there is another service which I just mentioned, review of the financial statement, which is for small companies, companies which are exempt from audit, and that's what comes under the international standards on review engagement. So there is a proper standard which deals with the service which is known as review of the financial statements. The only difference between audit and a review is the level of assurance. One of them has reasonable and the other one of them has moderate. Review of a financial statement is a moderate assurance engagement. According to ISRE, which is the International Standards on Review Engagement, a moderate assurance is less than reasonable assurance. So see, we got the answer. A moderate assurance is less than the reasonable assurance. So if I need to plot it, I will say RA is the reasonable assurance. Reasonable assurance is more than MA, moderate assurance. So reasonable assurance is more than moderate assurance, or moderate assurance is less than reasonable assurance. And the reasonable assurance is less than AA, absolute assurance. So reasonable assurance is an absolute assurance? No. Reasonable assurance is less than absolute assurance. Moderate assurance is reasonable assurance? No. Moderate assurance is less than reasonable assurance. So that's the definitions, right? You should be having for exam purpose. Now let's find what's the need of a review. Why a small company will opt for review, and what benefits will a small company get out of the review. We just got to know at the beginning of the lecture that there is a benefit of an audit to the shareholders, right? Let's find, is there any benefit of a review of a financial statement to a small company which does not even have the shareholders? Let's find out the answer. Review of a financial statement is a service offered to small and medium sized enterprises as an alternative to audit. We know the small and medium enterprises, normally known as SMEs, they are exempt from audit. So review is a alternative service for a small company, because small company cannot afford the cost of an audit even. And we know the SMEs are exempt from audit, but there might be a need where they want to hire an auditor. There might be a need where they want to take auditor services. But in that case, even they are not conducting an audit, because audit is not mandatory for an SME, right? They can get a service known as review, which is an optional service. Internationally, in every country, different corporate regulations exist, like a Companies Act in UK, which exempt certain classes of companies from external audit. So in every country, there is a definition of a small company, and whatever the small companies are, they're exempt from audit. They're not mandatory for them to have an audit, because audit is mandatory for listed companies which have a public interest, or where there is a shareholder and a director. If a small company wants to access a debt finance, for example, a small company wants to take a loan from a bank, will it be possible for the bank to disperse a loan to a small company on the financial statements prepared and presented by the management? This is the big question. We know small companies even go for taking loans from a bank. Even a sole proprietor, a person who is self-employed, at a certain point in time might need to go to a bank and ask the bank, I need a loan. Even a small company which is not listed, and they want to expand their business, or they want to buy a plant and machinery, and they go to a bank and say, I want a loan. But honestly, the bank do not disperse loan, whether they're dispersing loan to an individual or they're dispersing a loan to a company. They do not disperse loan without assurance. Even if an individual go to a bank, they will check the credit worthiness of the individual. They will check the background of the individual. They will check the past record of the individual. So the bank conducts the due diligence, right, of the customer, whether the customer is a individual or a customer is a company. Now, when a small company goes to a bank and a listed company goes to a bank. A listed company goes to a bank and say, I want a loan. The listed company have the audited financial statement. They can put on the table of the branch manager or the bank manager that these are my audited financial statements, and they have been audited by PricewaterhouseCoopers, or they have been audited by Ernst& Young. And the bank will get an assurance, okay, these are credible financial statements. But if a small company walks in to the bank and asks the bank manager, I want to take a loan of like $50,000 or like a $5 million, the bank manager will say, do you have your financial statements? I'll say yes. But the bank manager will say, are these reviewed by the auditor, or are these audited by the auditor? I will say, I cannot have an audit because I'm a small company. So the bank manager will say, can you just have a review of your financial statements for the sake of an assurance? So at least the bank gets an assurance that the numbers given in the financial statements are true and fair. And that is where the need of a review comes in, because I cannot have an audit as a small company. I can only have a review when I am in a difficult situation. Now, taking a bank loan is my need. And to fulfill the need, I need to get my financials reviewed by the auditor. So that is where the audit firms offers a service, which is known as a review of financial statement, which helps the small company in taking a loan. So if there is a review of the financial statement and you go to take a loan and you put on the table of the bank manager that these are my financial statements which are reviewed by the audit firm, because I'm a small company, that review will give them a moderate assurance. So something is better than nothing, right? If there is a zero level of assurance, no, there is a moderate level of assurance. So the branch manager or the bank manager will be very satisfied that the financial statements have a moderate assurance. That's something good. Let's disperse the loan to a small company. Perhaps no, the bank wants some assurance, right, on the financial statements by someone independent of the management. That's what we just discussed, right? So the bank will not give you loan unless and until your financial statements are reviewed if you're a small company. Thus, the auditor in such a situation can help a small company with a moderate assurance service. Now, the most important thing and the last thing from this topic of assurance. When we look at the scope of a review, because we need to understand that we are conducting an audit of a financial statement, we are conducting a review of the financial statement. One give rise to a reasonable assurance, one give rise to a moderate assurance. Interestingly, the audit firm is conducting the audit of the financial statement. The audit firm is conducting the review of the financial statement. Audit firm is the same. The level of competence is the same. The subject matter is the same, financial statement, financial statement. But the assurance level is different. A same firm conducting the audit of a financial statement and a same firm conducting the review of the financial statement. The subject matter is the same, the firm is the same, the competence is the same, but the difference between audit and review is reducing the level of assurance. If I audit the financial statement, I give a reasonable assurance. If I review the financial statement, I give a moderate assurance. So see, the level of assurance is fluctuating because of the difference between audit and review. So what's the difference? It's very important to understand. There must be a difference between how we audit the financial statement and how we review the financial statement. Because if I do the same amount of work which I do in audit and I do the same amount of work in review, then what's the difference? Ultimately, then I should give a reasonable assurance. But that means that the amount of work the auditor do in audit is more. That's why the auditor gives the reasonable assurance. And the amount of work performed in a review is less than audit. And that is the reason auditor expresses a moderate assurance. So where is the difference between audit and review? Eventually, I am looking at the financial statements, but auditing a financial statement and reviewing a financial statement has a big difference. And that difference is between scope, the scope of the audit and the scope of the review. You will be learning the scope of the audit in the lectures to come, but because this is a very small topic in your syllabus, which starts and ends in the first lecture, which is review. So let's first have an understanding of a review scope, because we have a whole syllabus to understand the scope of the audit. The scope of the review is restricted just to analytical procedures and inquiry. Now, when you perform a review of the financial statement of a small company, you cannot do anything else than the two. You can only do analytical procedures and you can only do inquiry. You cannot do any third thing. This is the scope of the review. And because of the scope, you're giving a moderate assurance. You're not giving a reasonable assurance. That means when I'm conducting the audit, I am not just confined to analytical procedures and inquiry. I can do these two in audit, but I can do many other things in audit. Let's take an example, just to give you an idea. The audit firm, right, is offering a service. On one side, the service is audit. On one side, the service is review. So when these are two different services, there has to be a difference. When these are two different services, there has to be a difference in the assurance and the way you work. Now, just to give you an idea, when we are conducting the audit and a review service is only restricted to analytical procedures. So when I go for a review of a small company, I will only do analytical procedures. I will just tell you what they are. And when we are going for review, I will just do inquiry and I'll tell you what inquiry is. But when you're going for audit, because audit has the more assurance level, which is for a listed company, you can do a lot many things. I'm not making a list, but I'm just giving you an idea that when I go for the audit, I can do both of them. I can do AP, analytical procedures. I can do inquiry. But because my level of assurance is more than review, so I can do something else, something else, something else, something else, something else. The list can be more broader here. And we'll be coming across that list later in the syllabus. But the amount of work you do in audit is broader, and the list can go up to 7, and technically it goes up to 7. So that's the reason I put 7, but the fill in the blank will come into the later lectures. But in audit, we can do like something like 7 things, which includes AP and inquiry. But in a review, we can only do 1 and 2. We cannot do anything else than 1 and 2. So can you feel the difference between the amount of work you have in audit and review? Or audit is like 7 things, which you will learn later, and review is just like 2 things. So can you feel that there is a big difference between the work we do between audit and review? And that is the reason the assurance level in audit is more, the assurance level in review is less. Because if I do more work, I will gain more confidence. If I do less work, I will gain less confidence. So the confidence in audit is more, and the confidence in review is less. But it's not zero, right? It's not zero. So that's an understanding, right? That the scope of the review is restricted to analytical procedures and inquiry, because I'm giving a very less level of assurance, which is less than reasonable assurance, right? And audit is something we will be exploring in the lectures to come. Now, that was my first concern point. And now that's where you need to know what are analytical procedures. Analytical procedures are also used in audit, right? So it's good for you to understand them once forever, because analytical procedures are also performed in audit as well as in review. But in review, we are only restricted to analytical procedures and inquiry, whereas in audit, we can do much more beyond analytical procedures. What are analytical procedures? Analytical means evaluation of the financial statement either by. Analytical procedure is a jargon, right, which you need to use in exam paper. It is a jargon of the auditor. It is a procedure of the auditor through which the auditor gather evidence. Now we know the auditor needs to gather evidence, right? So analytical procedures is the way through which the auditor gathers evidence on the financial statement. That's the way he's checking the financial statement, because without checking, you cannot give an assurance. So analytical means to analyze something, right? Analyzing something means evaluating something. So what is the auditor analyzing? The subject matter. What is the subject matter? The financial statement. So auditor is evaluating the financial statement either by comparison of the current year with the last year. So auditor will compare the current year sales with the last year sales. Auditor will compare the current year expense with the last year expense, the current year profit with the last year profit. And if there is any increase or decrease over the last year, auditor will inquire the management why. If the sales have increased a lot from the last year, why? If the sales have decreased from the last year a lot, why? If the depreciation expense has increased a lot from the last year, why? Or if the depreciation expense has decreased from the last year, then that's unusual. Why? If the tax expense has increased, why? Reduced, why? So auditor needs to ask these questions, right? Because auditor is skeptical. Now, when the auditor is skeptical, we know skeptical means auditor should have a questioning mind. Now, when the auditor have a questioning mind, if you do a comparison, you will find either something is increasing or something is decreasing. Now, when something is increasing or decreasing and the auditor is skeptical, so the auditor will ask a question to the management, why? And that's where the auditor is gathering the evidence on the financial statement in the case of a review. Trend analysis over a span of time. We know trend analysis is not just last year and current year. Trend analysis is like 4 years, 5 years. I want to see the sales trend. I'll say, okay, what has been the sales trend in the last 5 years? I want to see whether the sales have been increasing in all the last 5 years, because that is the trends, right? So trend analysis, and if there is anything unusual in the trend analysis, then obviously the auditor needs to inquire. Ratio analysis, the auditor can do the ratio analysis for as in like evaluation of the financial information. Auditor can do the ratios like inventory days, receivable days, gross profit margin, etc. And if there is anything unusual in the ratios results, the auditor can ask management why. Budgets, the auditor can compare the budgets versus the actual. If there is a big difference between actuals and budgets, the auditor should ask management why. Or if the actual is more than the budget, then also you should ask the management, why have you done overspending? Industry trends and averages. My company versus the industry. My company's sales are increasing, but the industry sale is decreasing. Why? Or the industry sale is increasing, my company sale is decreasing. Why? So do you understand these 5 examples of evaluation? So auditor is evaluating, but with that evaluation, the auditor needs to be skeptical. Because if you find anything unusual in the evaluation, the auditor needs to inquire the management. Skeptical means questioning mind of the auditor. The auditor needs to inquire the management why. And that is where the auditor gets the evidence on the financial statement. So when you are performing a review of a financial statement, you are only performing the analytical procedures, and you are asking the reasons of unusual things you identified from evaluation, analytical procedures to the management. But if you are conducting an audit, you can do analytical procedures and inquiry in the audit even, but you can do more things, extra things. And that's where the assurance level will rise in audit. And that's where the assurance level will reduce in the review. Inquiry, we just covered that. Just go through the definition. Inquiry of management is carried out by the auditor to find suitable answers. So auditor wants to get suitable answers of why things are increasing and decreasing, of any fluctuation in the financial statement over the period, and assess whether the answers is in line with auditor's skepticism. So auditor needs to take an inquiry. Inquiry is a way you gather evidence, right? So how many ways we have to gather evidence in a review of a financial statement? Two: analytical and inquiry. And I've given you the definitions. These definitions are valid even for audit. So it's not just for review, right? But currently you're understanding the scope of review of financial statement. The last thing, the auditor at the end of a review engagement issues a review report, just like an audit report. Auditor will now issue a review report because he has gathered evidence, where the auditor expresses a moderate assurance over the financial statements in the form of the following statement. Now, when the auditor do the audit, auditor publishes an audit report, and in the audit report, the auditor gives an opinion. And in the opinion, the auditor says whether the financial statement gives a true and fair view or not. When you conduct a review, again, you will publish a review report of the auditor. And in the review report, you will give a moderate assurance. And I just mentioned that moderate assurance is less than reasonable assurance. And you've just conducted so less work. When you've conducted so less work, you will be bit um, negative. You will be bit, you have a bit more risk because you conducted less work on the financial statements. So your body language or your level of assurance will not be that much, which is in the audit, because in audit you do a lot more work, so your body language automatically becomes different, or the negative mindset becomes more positive because you've done so much work. Now, if I have done less work, I will be bit more underconfident, and that's where I'm giving a moderate assurance, right? See how you express a moderate assurance. See the language, the body language of the auditor when the auditor is expressing a moderate assurance. Open inverted comma. Firstly, you're telling we have conducted a review, not an audit. So first thing you're telling to the small company or the bank who is giving you a loan that we have not conducted an audit, right? We are only conducting a review. So what are you telling first? You're telling the limitations. You're telling we have conducted a review, not an audit. So first thing you're telling is your limitation, because you want to give a very important statement here that don't expect a reasonable assurance from us. Don't expect that we have worked a lot. We have just worked on analytical procedures and inquiry because we have conducted a review, not an audit. So first you put your limitation. Then you say, open inverted commas, based upon a review. Now, you know, review was based upon what? Analytical procedures and inquiry, comma, nothing has come to our attention. Based upon AP and inquiry, nothing has come to our attention that causes us to believe that the financial statements of ABC company as on 31st of December do not give a true and fair view. So you're telling the management of a small company or the bank who wants to give you a loan that based upon a review, nothing has come to our attention, which causes us to believe that the financial statements do not give a true and fair view. So, what is the final message? You are telling the bank manager or the management that nothing came to our attention. Everything is fine. There was no window dressing, there was no fraudulent activities based upon our review, based upon the limitations. But see the way you are expressing it. You could have even said, based upon our review, the financial statement gives a true and fair view. Because eventually you are trying to say the same thing. But see the way you are saying that. That is very important. When you are less confident, you cannot be blunt. in the audit, the audit is so confident, he says, in our opinion, the financial statement gives a true and fair view, full stop. See the blunt line, because he's confident. But over here, you have you have done so less work. So first you said, we have conducted a review, not an audit. You build a perspective, and then you say, based upon our review, nothing has come to our attention that causes us to believe and drag. If you would have been confident, what you would have said, based upon a review, the financial statement of ABC company gives a true and fair view, because that's eventually what you're trying to say. But you're trying to say that in a very negative manner, or in like a very underconfident manner. I hope you can pick that sense of language here. So, moderate assurance from the examination point of view, and from the point of view, the multiple choice questions, you should know that moderate assurance is also known as limited assurance. But don't get confused if you get this word in exam paper. Moderate assurance is also known as limited assurance. And the way we express that nothing has come to our attention, that financial statements do not give a true and fair view, the way you express that, it's also known as a negative assurance. So don't get confused with any of these words being used in exam paper. Moderate assurance is also known as limited assurance, is also known as negative assurance. So these are all three synonyms. They are all synonyms to one another. Right? So please assure that you go through the lecture, maintain your notes. You will be getting this, you will be making your notes yourself of this topic, because this is the first one, right? This is the first lecture on the course of AA, where we started with the syllabus area A, which was audit frameworks and regulation. And in that first syllabus area, we spent time on the very first topic, which is to understand the correlation between audit and assurance. And within the lecture, so many things have gone down. So what's the learning objective of this whole lecture? Let's find the answer. Now, from the very first lecture today, what have you learned and what you should be knowing from the first lecture? What are learning outcomes of the first lecture? Number one, to know the benefits of external audit to shareholder and the benefits of external audit to the stock market. Number two, the purpose of external audit. Right. The two types of assurance levels, definition of reasonable assurance and definition of a moderate assurance. The difference between the limitations of an external audit, and why the auditor cannot give an absolute assurance. Limitations of the external audit and why the auditor cannot give absolute assurance. The next, the difference between external audit and a review of financial statements in terms of scope and assurance. I've covered the scope, right? And assurance. And the final thing is why a small You should know the synonyms. You should know the synonyms that moderate assurance is also known as limited assurance and is also known as negative assurance. And prior to that, you should also be knowing that what is the scope of review of financial statement. You should know analytical procedures. And what are they? And you should know inquiry and what is inquiry. So these are the learning objectives, right, from your lecture 1. If you uh, can take a printout of these learning objectives and then start to listen to the lecture and then assure that everything from 1 to 8 has been covered, take out a box file, put this printout on your box file, lecture 1, and take your notes of lecture 1, put that in the box file, and that closes the first lecture of your syllabus, right? I will be seeing you back with the lecture 2 of the AA course. This is it for the first lecture. Goodbye and Allah Hafiz.